Mike, explain the strategy.
Hi, Kelly. How are you? Look, we've been through a massive rotation this year. I'm not sure most investors or people who are casually watching we realize that, the first sort of 3-4 months of the year, we had a massive rotation into small cap value stocks, which of course are led as sort of an archetype by the small banks. They were up tremendously ahead of the S&P 500 and particularly against sort of the FANG stocks. That entirely has washed away and turned around, and now small cap value and small cap stocks are down on the year relative to both the S&P and mega cap stocks and mega cap technology, in particular large cap mega cap. So, we've seen this big rotation, and the question is, these both are really sensitive to direction of interest rates. So as the 10-year goes, it seems like if interest rates fall, equity flows go into large cap tech names. If yields on the 10-year rise, we see flows into small bank stocks and small value stocks in general. So, look, we're pretty careful about trying to be clear what we can reasonably have an opinion on. Interest rates are pretty tough. With all the cross currents we have, the political dynamic, the change in tax codes, and all the things coming, we think, look, I'm not particularly, I don't have an advantage in trying to pick which way rates are going to go. So as a natural hedge in a portfolio, we really like this idea of staying with the massive cash flow generation of the large cap tech names and hedging that with small cap value should interest rates rise and we get a little inflation back. And so that's sort of the portfolio construction idea we're thinking about.
Sure, and you say quite simply, don't buy bonds. So if people want to if you have a strong view on rates, you're saying you can kind of benefit either way from this, or if they're going higher, if they're going lower. And if you're one of those investors who's like, I've stopped trying to guess what rates are going to do because I'm banging my head against the wall, then this would also work for that. I also like your other theme here, which is investing in thematic investing inside old line companies. Tell me about Teradata and Magna.
Well, so for example, there's so much noise and buzz around the sort of innovation economy and how things are changing, and the names and the stocks that participate in those areas are exceptionally valued by almost anybody's reckoning. And so we're thinking about, okay, where can we find some of that innovation? Where can we find an old line company that's changing quickly to come up and maybe arbitrage some of the difference in valuation? So, for example, if you look at Tesla, it's somewhere around 17 times sales. Electric vehicles are doing incredibly well. But we think an interesting company called Magna, which is an OEM producer, is transforming its business as we speak. They're trading at 10 times earnings. They pay a dividend. So what we're looking for is just a little bit of recognition that type of company can actually get some of the valuation, maybe not a premium, but some of the discount away, and we get a little bit of relative performance there. Same thing with Snowflake versus Teradata. Teradata is sort of an old line software company, clearly in the middle of changing their stripes, competing more directly with Snowflake. The differences are massive in terms of valuations. And again, you see TDC, Teradata, start to work, and it's been working over the last 3 or 4 or 5 months. We think we're onto something there as these companies adapt to new environments. So finding an old company that's had a hard time adapting, has a cheap valuation, but you get smart and thoughtful management trying to chase and understand some of the new world economy, I think is an interesting way to think about investing.
Shepard Smith here. Thanks for watching CNBC on YouTube.